Good morning. This is Tom Alexander. It is Saturday, April 8th, in rather cold, gloomy Charleston, South Carolina this morning. We're having some unseasonally cool and weather. The dampness is not a big surprise. Spring showers, but it's accompanied by cool weather. Anyway, this is the video addendum to the written report that most of you should have received, if not all of you. If you are finding me on YouTube and you want to receive a free written report that accompanies this video report that I do weekly, just shoot me an email to tom@alexandertrading.com. I will put you on the list. It's free. Also, if you find value in the video, if you would like it, subscribe, send it to your friends, make comments, ask questions. All of those things help build the channel through the magic YouTube algorithm. Okay, let's talk about the markets a little bit. We remain in this incredible macro fight in the big money, the institutions. You know, I'm a price-based trader, but we all know that it's the institutions that will generate direction over time, and they are in this. I call it a fight. They're in this. They're two camps right now in the institutional world. About everybody agrees on what's happening, but they can't agree on its implications for price near term. Now, I find that amusing. It's not something I trade on. I use price action. It's why I'm not a macro trader, and I use auction principles that I think are the most objective and consistent form of identifying value, because you're identifying value through market behavior, through the actual buying and selling of market participants. So that is the reality. You make money if you're long and the market goes up. You make money if you're short and the market goes down. The exogenous reasons, ultimately really don't matter. So, I constantly preach about trading a narrative, and it's very easy to get caught up in a narrative case now. I warn against that. Let's just follow the price action. Now, I think by looking at the auction, let's look at the charts here for a minute. Okay, here are the cash charts of the 4 primary U.S. trading indices. And let's just take them one by one. Now, I put weekly charts in the written report. I'm not going to go through those today, but in the video, but they're in the written report. Here's a critical upper level. The critical downside level is last week's low. Now, last week's low is on the cliff of this giant elevator shaft. And this is true in all the indices to the downside. We had gap, 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 and those gaps still have not been filled. There's nothing magical about gaps. They don't have to be filled, but they usually are just through a rotational process. Now, if we do ramp higher next week, and we take out last week's high. This is why last week's highs and lows are very important in each of the respective indices. If we take out last week's highs, we don't have to run to 4,200, but I have a hard time visualizing when you put all the pieces together of this stuff, the technical pieces and the price action pieces. I have a hard time visualizing that we're just going to blow through this 4,200 level. Now, how far away is that level? It's not that far. That's a super strong day or a pretty strong 1, 2, 3 days up into this area. If we do trade straight up into this area, I think you'll see some pushback. I think you'll see some balance before you trade straight through it. Now, if we trade below last week's lows, it opens up a lot of range to the downside. How much, you really don't know. Okay, let's look at the NQ, because it's been on fire. Now the NQ, the next level above last week's highs in the NQ, and I've had this level highlighted for weeks. You can go back and look at the other reports, which I also put in each report, written report that I do. I put the previous 4 reports in there, so you can go back and you can track what I have been saying, and you can follow the logic, and you can determine for yourself if this is a useful methodology. I encourage you to do that. I always encourage people to disprove my work. And you should do that with everything you use, by the way. Okay, so this is last week's high is right here. Last week's low is right here. These are important levels. If we do close above last week's high, it doesn't mean we're going to trade straight to the August highs. All it means is that there is no objective resistance from an auction market perspective until you get up into those August highs or near those August highs. Now that's a pretty healthy 5% away. That's pretty healthy even for the NASDAQ. All right, let's look at the Dow. And the Dow is already just below an incredible amount of volume on the horizontal scale, or what a lot of the market profile people like to refer to in a fancy way of supply. There's supply here. True. Okay, let's look at the Russell, which I think is the canary in the coal mine of the whole shebang. This is a giant balance area. I put the profile, well, we'll look at the profile view since we're here. But last week's high is critical. There's nothing below last week's low until you get below the March low. And then below there, you're looking at the fall lows. This is what the profile view looks like. This is where we closed right here. On Friday. And you can see we closed right at the upper cusp of the high volume node of the structure that goes back for a month. So a break above last week's high in the Russell could be very bullish and has to be respected. We really need to take a look at everything that's surrounding, that is accompanying that if it occurs. Okay, where was I? Let's go back over here. That's not where I wanted to go. Here we go. Okay, so we've covered the indices. Let's take a look at the technical situation now. Okay, so now this is the SPX, the S&P 500. This is roughly 4,200. So this is, we got 2+% to get there. Now, this is the 10-day moving average of NYSE advancing issues, the red. The green is a 5-day moving average of advancing issues. And last week I said, I was pounding the table with, we were close to at least some sort of short-term balance where the market was extremely unlikely to continue at that rate of change. And that's going back, looking at this stuff and staring at this stuff for years and years. Now, this is sort of a blunt instrument type of thing. It's contextual. It cannot be rote traded, but it can give a good rough idea about what to expect and maybe what not to expect, what would be an outlier, etc. Now, I would not be surprised to see last week's highs taken out. I would be surprised, as I said earlier, to see this market just blow through 4,200. We have a 10-day moving average that is below a real hard extreme for the 10-day moving average, but we've already seen the 5-day moving average of NYSE advancing issues reach an upper extreme. Now, it reached an upper extreme over here as well. Right here. And we can see the market went up ultimately before we got a very significant retracement. It went up another almost 4.75%. However, you can see it began to get very two-sided, where you would have these, each leg up would end, it would balance, you would have retracement. Then you'd have another leg up. It would end. This was a very deep retracement. Now, this could play out between here and 4,200, or maybe even just above 4,200. But I would be surprised now if we see a 5-day NYSE breadth reading that is anywhere close to as extreme as we saw on the 31st. And what would be more likely would be something like this, where you have these rallies as you're forming a more important top. Now, could an important top already be in place? Yes, it certainly could. This is correlation. It's not causation. It's context. But that's what I'm looking for. I would be surprised if we have 2 or 3 strong up days into this 4,200 area. You want to be looking for signs at that point. Again, you always have to take the situation when it occurs, and you have to look at what's going on around it, which brings me to, which is a very nice segue into 30-minute breath work. Now, this is something that I find extraordinarily useful on an intraday basis as well as an intermediate term basis, as long as you frame it in the larger degree context of what's going on. So we've had this classic bull leg pattern in price breadth, where the market, and last week, not last week, but the week before last, we had 5 consecutive days with the market not able, even intraday, to get below positive breadth. That's unsustainable, and that was one of the reasons I was pounding the table back a week ago, that we had to be close. We were very likely close to at least a short-term top and at least some balance, and that's what we got. Now, we have a deeper retracement last week, and the market is set up to create divergences in this. Now, we can go higher. I mean, we can go considerably higher, but it's likely, based on precedent experience watching this stuff for years and years, it's likely to be in a pattern where, okay, you go to a higher high, breadth comes nowhere close to the levels that we've seen at this upper extreme in this rally. It gets somewhere like it here, and then you have a price retracement deep into this leg, but maybe not taking out the pivot. It goes down like this, then it goes up again, and maybe it does this number into the 4,200 level, and in the meantime, breadth continues to make a series of divergences. That, to me, that is an ideal trading situation. It's something we'll be watching very closely on a day-to-day basis next week, in real time, in the live trade room. Information about that, if it's something you're interested in, is in the written report. You guys have a wonderful remainder of the weekend. Have a happy Easter. I'll speak with you again very soon.